Annuities may have gotten a bad rap in the past, and in some cases for good reason, but the products today could add important benefits to your retirement plans. I'm Patrice Sikora with your host, Brendon Murphy. Brendon, this topic can be something of a rabbit hole. So let's just start with an overview. Tell us, what is an annuity and how does it work?
Hi, Patrice. How are you today?
All right.
So first off, the annuity is it's a simple word, security. It's about security. It's a deal between yourself and the insurance company where you give a sum of money, depending on what it is, whether it's $50,000, $100,000, $1 million, whatever it is. The key purpose is principal protection. Once you give that investment to the insurance company, your principal is protected. Market loss, you stay there. It's about security. And then the second part is about guaranteed income later on. Okay? We talked about guaranteed income a while back about Social Security. Social Security is an annuity. If you have a pension, that is also an annuity. Okay? So the guaranteed income is a structured set of payments that can come monthly, quarterly, or annually for the rest of your life when you set it up properly.
Okay, so you've got the annuity, you've put the money in, and it sits there. What's it earning here?
So it earns depending on how you set it up. It could be in a fixed bucket where you get a fixed percentage, technically like a CD, but these grow tax deferred. So CDs you get taxed every year on the amount that you earn on your interest earned. Annuities grow tax deferred. So you don't get taxed on the amount of interest you earn until you start to pull it out. So it's compounding every year. And then at the end, you can either turn it into an income stream or a distribution method that you can take yourself.
Okay. So are there different types of annuities?
There's technically 8 different types of annuities, but we can focus on 4 because the 4 main annuities are what people talk about all the time. There's an immediate annuity, which is I'm going to give a certain amount of money to the company, and the company is going to start paying me out immediately. Obviously, the immediate annuity is going to pay out immediately for either a certain amount of time, whether it be a 5-year or a 10-year pay or a lifetime pay. Okay. There is what's called a MIGA or a multi-year guaranteed annuity, which is comparable to the CD. So the MIGA will give you a fixed interest rate for either a 1-year period all the way up to a 10-year period. So if we use a 3-year, for example, and it's a 5% guaranteed rate for those 5 years. So you get 5% 1, 5% 2, 5% 3. And at the end, you can either move it to somewhere else or you take the distribution and pay the tax on the interest. Okay. Then you have what's called the fixed indexed annuity. These are what are mostly used today to create guaranteed income. Okay. You give your $100,000. You say, I would like income in 3 years. It's going to roll up at a guaranteed rate. And then at that time, we use your age and a percentage payout that will pay you a guaranteed lifetime income that you can't outlive. Okay. Then there's a variable annuity. I don't deal in variable annuities. Well, we don't market them here at Compass Financial. But what they do is they give you some guarantees. Your principal can go up and down. Okay. And at some point, you're paying fees that are inside somewhere in that 3.5% to 4%. Okay. So if we get into fees and things of that nature inside the annuities, usually a guaranteed income. Some companies have free income riders. Income that guarantees life forever, or sometimes you have a fee that you pay to guarantee that payment's there for forever for you, and sometimes jointly for your spouse, depending on how you set it up.
All right. So at first glance, these sound pretty good. What was the big problem with them in the past where they got such a bad reputation?
Well, some people didn't really understand what they were getting in. They heard what they heard, and it wasn't like, hey, there were caps back then. So if we're talking about when they first came out, caps and what are now called participation rates are how you make money inside your annuity. Okay. Yeah. So if we were looking at interest rates back in, let's say the 90s or a little 2000s, we were at a cap rate of 3%. So if the S&P did 10, you only got 3, right? So that's a large give up on your interest, right? So
it's
if you're
huge.
If you're in the market, it goes up 10%, you make 10%, right? If it goes down 20, you lose 20. Mm-hmm. And in the time of that, if the fixed index annuity at the time, the cap rates were 3 and they were doing 10. So a lot of people didn't understand the give up or the indexes and most of them were all based around S&P at the time, or maybe a Russell or a NASDAQ, depending on where you were. Now there's so many indices. Every bank has an index, and that's how it credits interest inside your account. So whether you want a fixed rate, which, like I said, it could be like 4%, you get a fixed every year, you could take income from it, or you could have a cap or a participation rate. And if we did like an S&P participation rate, say the S&P participation rate was 70%, okay? We'll use 70 as the number. The S&P does 10%, you get 70% or 7% of the 10, okay? And that's how you would make interest in the market. So let's say if you invested the $100,000 and you were in the S&P participation rate at 70%, it does 10, you get the 7, it locks in, so now you're at 107,000, right? The following year, the market drops 20%, right? You're still at the 107, okay? You didn't lose any money. The next year, it goes back up 10. You're now at 114,000, 115,000 the next year. So the like I said earlier, the security part of the annuity is principal protection. It's about whatever you invest inside the annuity cannot lose a dollar, okay? Unless you have an income rider, which that subtracts, kind of like your brokerage statement. You see it once a year on the bottom line. It tells you the fee you pay to make sure you have guaranteed income paid for your life, okay? And guaranteed income is important because we talked about Social Security a while back. If you have a husband and a wife, and say husband passes away, wife maybe bumps up to husband's Social Security, or if she's the top earner, that's her Social Security, and then they had annuity on top of it, that could,
make up the difference.
Make up the difference for the income going forward.
Right. When you talk to somebody about an annuity, are we still in the educational process to explain these are not as bad as some people will have you think?
Yeah, absolutely. We're all about education. We want to make sure the person sitting across from us understands what the point of the annuity is. Because if nowadays without pensions, right? Well, we talked about this, I think, before. Is that 4% of America doesn't have pensions. So what they're doing now is they're saying, hey, you have a 401k, it's worth $1 million. Somehow you have to start at some point taking distributions to live in your own world when you retire, right? Social Security is there. You're going to have some type of it. And then where's the rest of the income coming from? Are you taking a withdrawal from your mutual funds or your stock portfolio every month, or every year taking one lump sum? Or if you could have an annuity with guaranteed income, you can base out your pay scale just like you were when you were working to say, like, hey, I needed to make $7,000 a month. Then I still have my investment side that is, moving with the market and keeping up with inflation along the way.
Are annuities subject to RMDs?
They are, for qualified dollars, which is IRA dollars. If you have a 401k and you roll it to your own personal IRA and stick it inside the annuity, yes, they are. But if you're taking guaranteed income, that can satisfy in some certain cases the amount you need to take out for your RMD. So now that the age is 72 and a half, you would look and say, like, okay, I have these qualified dollars, but I'm taking guaranteed income. So until you hit that threshold, that annuity can satisfy the payment going forward.
Explain the IRA rolling into the annuity.
So if you have a 401k, we talked with Brendon Murphy, our financial advisor that we deal with. When we look at somebody's 401k, and let's say that you have a 70-30 split stocks to bonds, we might say, hey, listen, if we take this 30% and we roll this portion over, so let's say it's $1 million, that would be $300,000. You would roll it to the annuity. So that's a company-to-company transfer, which is non-taxable. You would put that in the annuity, and they would say, hey, I'm going to retire in 3 years. So 3 years, you're going to wait, and then that company is going to pay you based on your age and the percentage of your age, because that's how it's based on. It will pay out guaranteed monthly, quarterly, annually for the rest of your life. And for a small difference, kind of like a pension, so maybe like $500, $800 less, you could do a joint annuity, which would pay you and your spouse for the rest of their life. So you can set it up just like a pension. That's why I said earlier, pension is just like an annuity, because that's what that's what it is, right? So you can do it singly, you can do it jointly, and then God forbid something happens to you, whatever's left in the contract goes to your beneficiaries that you name on the contract.
I mean, this sounds like a no-brainer, but it also sounds like there are so many questions that you really need to ask to find the right one for you.
Yeah, because it really just depends on your scenario, right? It's about, some people that, if they have millions and millions of dollars, maybe the annuity is not for them, right? It's not because, hey, okay,
Hmm.
I have $10 million. I don't really worry about it. It can be for them because, hey, listen, I'm going to stop working. I just need income. And the rest of it's going to stay in the market and grow. So people that are blue collar and they don't have pensions anymore, because that's what, my parents grew up on. They're blue collar. Most of the people in Delaware County where we live or the Delaware Valley are blue collar. Those guaranteed payments are missing. And they're like, hey, go figure it out. So now it's on them to come figure it out. So when they come to ask us questions, we're going to say, well, where's your income going to be when you retire? Because that's the benchmark. So that dictates depending on what annuity or what company we're going to recommend. And we represent, because we're independent, I think about 30 to 35 different companies. So it really just depends on the situation of the person, or the person or couple in their situation going forward.
When is the best time to start considering the possibility of an annuity? Your 40s, your 50s, after retirement?
We have some clients that are in their 40s that were like, hey, we made a bunch of money and we want to just protect it now. And so you can do it that way. I think it's the pre-retirees. I think the key is like that 55 and up. You're getting close to it. You're a federal employee. You're getting close to retirement. You're a teacher. You've been in 20 some years. You could roll out a piece of your pension to help stabilize your income later on. I think that 55 and up crowd is really where it has been.
Okay. All right. And how long does it take to get one set up?
It really depends. It could be if it's personally owned, the IRA or the 401k, or not the 401k, but the IRA. It could take, after a couple conversations and you understanding what you're getting into with whatever financial advisor you use or person who helps you set up the annuity. I think I would say the month is the way it goes, because it's going from company to company, and sometimes they have paperwork on each side that you have to meet the requirements. You also have to be suitable to buy an annuity. If you only have $100,000 and somebody says to you, hey, you should buy an annuity, that's probably not the best investment for you, right? Because it is a long-term investment, and if you're not working, that's all you have.
Quick question here, too. You just said long-term investment. Get that. What if suddenly you need access to that capital?
So besides the guaranteed annuity, you have, if you're in that, depending on the contract you set up with the company, whether it's a 5-year, it could be 5, 6, 7, 8, 9, 10, right? The highest you can go in the state of Pennsylvania is 10 right now. So you can get 10% penalty-free withdrawals every year, sometimes 30 days after you open the contract, all the way up to the 10th year. Or, sometimes there's liquidity provisions inside of it where if you don't take 10 in the first, you get 20 the next. Oh. So there are options. There are return of premiums inside annuities. So our job here is to make sure that we're up to date on all of the annuities in the space, right? In case someone came to us and say, hey, I have an annuity from XYZ company. Is there any way you can review it? Absolutely. If you bought a non-qualified annuity back in the day, or if you bought a qualified annuity back in the day and you haven't done anything with it and you don't understand it, because I have this product, but I don't get it. We sit down with clients and sit there and be like, hey, we'll walk you through what it is. Is this the best thing for you? Because you could be losing money because you're setting those caps that we talked about at 3%, where the caps now are 7 and 8, where the participation rates are 150%, not 50%. So we'll also do that for clients or customers that we'll talk to.
And that leads me to the question, Brendon. How can people reach you?
So they can reach me. I mean, they can call us at 610-449-9900, or they can find us on www.mycfsi.com. And we have a video conference. You can literally send us a video and ask us questions, and it'll come back with a video. So it's a video ask. You can ask us any questions, whether it's about annuities, retirement, long-term care, it doesn't matter. But if that's the question you have, or retirement planning, you can just click that video, send us a message, and you'll get a video back from myself or Tom, or it's mostly me or Tom. So we can take care of that and just answer a question.
Fantastic. All right, folks, so don't be afraid of annuities. Just be sure to ask the questions. Brendon and the people at Compass Financial Solutions want you to understand what might be best for your retirement dreams. Follow this podcast for more insights and info on all topics financial. And of course, please share with others. And thanks for being with us.
Thank you for listening to the Compass Wealth Conversations podcast. Click the follow button to be notified when new episodes become available. Visit our website at www.mycfsi.com. That's www.mycfsi.com. Or give us a call at 610-449-9900. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Compass Financial Solutions Incorporated. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Please note that the information provided in this podcast is for general informational purposes only. All opinions expressed by the hosts and guests are solely their own opinions and do not reflect the opinions of any institutions or entities they may be affiliated with. This podcast should not be considered as financial or tax advice. We strongly recommend consulting with a professional financial advisor or tax professional to get advice tailored to your specific situation before making any financial decisions.